Hi there, and welcome to another episode of the People of Private Capital. This week, we talk with Sean Banks, a partner at TTV Capital based in Atlanta, Georgia. TTV Capital are a prolific investor in the FinTech space, and I talk with Sean, a recent inductee into the Georgia FinTech Hall of Fame, about his 20-year-long career with TTV, what led him to initially engage in the venture capital sector, the successes that he's had along the way, and also some insights into the challenges that came with the crashes and the subsequent growth of the 2008-2009 period and beyond. It's a compelling conversation. I hope you enjoy it here on the People of Private Capital. Okay, Sean. Well, clearly a lot going on there. Very keen to talk to you about all of that in some detail here on the People of Private Capital. Thanks very much for joining us on the podcast.
Glad to be here for you. Thanks for having me.
Yeah, it's great. And I should just say up front, TTV, in addition to being a tremendous partner for us in terms of an investor in asset class, has also been an invaluable source of advice and guidance and working with Gardner as a board observer at asset class, and of course the broader team. It's been a pleasure to work with you guys over recent years. So I'm disclosing that up front. But Sean, just as the title of the podcast suggests, keen to understand the People of Private Capital. And for people who don't know Sean, don't know TTV, could you start with just a brief introduction to yourself, and then a quick introduction to TTV in terms of your area of focus?
Sure, happy to. I'm Sean Banks. I'm a partner at TTV Capital. I joined TTV Capital back in February of 2005, so I'm going over, now 20 and a half years doing this. TTV Capital is an early stage fintech investor, venture capital, seed, Series A. We launched the firm, Gardner Gerard and Tom Smith launched the firm back in 2001. I actually interned with them during my MBA in 2002, returned in 2005. We just now are finishing up the deployment of our STIC fund, which is the $250 million vehicle. We've deployed $750 million across the fintech space now in the last 2 to 5 years.
Yeah. Wow. So that was the 23 fund, right? Yeah. Okay. Yeah. Yeah, incredible. And you're focused entirely on the fintech space. Is that true to say?
That's absolutely true to say. We've been focused on the fintech space before there was an expression or a firm fintech. Back when
Right.
we started, it was tech-enabled financial services. A little bit
Yeah.
of alcohol now it's tech.
Yeah. Yeah. And you guys are based out of Atlanta. Obviously, has established a tremendous reputation as being a hub of innovation. I think they call it Transaction Alley or some similar moniker. But fintech has just been going through a tremendous boom over the years in Atlanta. Why is that? What's the attraction of Atlanta, or what set of circumstances exists there to attract talent and, of course, investment from firms like yourselves?
Well, historically, Atlanta was somewhat of the capital of the southeastern United States and had a substantial presence in the banking sector. However, the state of Georgia had some fairly restrictive laws around cross-county banking. So, in order for a bank to have a presence, it actually had to have a physical branch, and Georgia's divided into 158 counties. This is a little bit of a long history lesson for you, but this is what happened when
Yep.
North Carolina and Charlotte started to becoming when banking hub. They came in and bought a lot of the very large banks in Atlanta, moved much of the executive teams up to Charlotte. So that's where you got your Wells Fargo, Wachovia, Wells Fargo, Bank of America. But they left a lot of the transaction processing talent in Georgia. And
Hmm.
so over the years, between TSYS in Columbus, Global Payments in Atlanta, with FIS, Fiserv, NCR, large presence here in Atlanta, Atlanta became essentially the payments capital of the world, where you had 60% of every credit, debit, and prepaid card transaction processed globally had some sort of very large affiliation with the state it worked in. So that cluster really gave us that last mile of connectivity in Atlanta, in Metro Atlanta and Georgia, to both the merchants and the cardholders through our transaction processing route.
Yeah. Yeah, it is incredible. Prior to, or at least a little bit further back in my career, I worked in the credit card security industry, and I had the pleasure of working with a number of companies in that part of the world. Spent a lot of time in Atlanta, so I mean, it is crazy to see how concentrated all the major brands are there. It's incredible. Before we kind of delve into the detail of TTV, just by way of background, your background and what brought you to TTV, you mentioned, I guess, your first foot in the door at TTV was in 2005. I believe as an intern, summer intern, if I'm
2002, summer.
2002 as an intern. Okay.
Yeah.
And you
So
came back then full time in 2005. Is that's okay. Yeah. Yeah, very good. And what attracted you? You started out, your background, educationally speaking. Can you talk through that in San Diego, and prior to that,
yeah,
your
so I mean, it's a very traditional path to venture capital, right? You
yep,
stop at the U.S. Naval Academy, you serve on active duty, and my last stint was out in San Diego, and I was very this was would have been in the late '90s,
yep,
and as I started to think about what my career would be after my military service, I liked what was going on out in Silicon Valley, and the attraction and the allure of new tech and the growth of business, and starting something new. And so I went to law school during my final tour in San Diego at night.
yep,
Finished that up. My wife and I both are from Atlanta. We moved back to Atlanta. I went to get my MBA over at the Boyd School of Business at Emory, where
yep,
Gartner also had won. And during that summer, it was post 9/11. There were not a ton of internship opportunities. Gartner was kind enough to let me come over and work for him and Tom during that summer. I stuck with a startup post graduation from business school, sort of serving in a legal and a finance role with that organization. And
yep.
when Tom and Gardner went to raise their second fund in 2005, they asked if I'd come back and join them to expand the team, and we've been partners now ever since.
Yeah, yeah. So like you say, not the most traditional route, but you decided not to go down the legal route despite your JD and all those years of study. Just wasn't for you, or you just found the attraction of
So the overall mission that I had in the North Star at that point in time, when I would have not even a career at that point, was to find a way to work my way into venture capital. And
absolutely.
um, as I looked across the landscape of what kind of tools are in your tool belt,
Yeah,
having a JD seemed to be something that would be very beneficial. When we negotiated our term sheet with you, Bertie, I got to beat you up a bit because I understood
yeah,
the law a little bit more than maybe some of the other folks that you haven't had to mess
yeah,
with. So the intent there really was to find an ancillary degree that I never intended to practice law, but would become very valuable as I moved into practice.
yeah, yeah. Yeah, very good. And so you were involved in the formative years of TTV. What did that look like at that time? I mean, was it virtually any other task, fundraising? Um,
So it was Tom Gardner and myself.
yep.
Uh, we had occasionally we would have an associate, but not necessarily full time.
Hmm.
And with three of us, effectively did every role you could imagine, from general counsel and CFO for me, for
Hmm.
raising capital under Gardner's bailiwick. The three of us working on marketing, and we sometimes go back and look at the marketing materials and some of the products that we crank out, and that you can tell we really did not have a whole lot of artistic marketing skill sets around the company. So
Yeah.
It was, all hands on deck. There's no job too big or too small for any of us to take on. And it's a lot of fun, but it's a great way to develop a culture. It reminded me a lot, frankly, of the culture you would have at Virginia Military, so where you really do have to do a lot of things that you may not have thought you were going to do when you were, moving towards your commission. But you're working, you're getting stuff done, and no jobs people.
Yeah. Just a quick interlude. I'm Ferdy Roberts, CEO and founder at Asset Class. And at Asset Class, we provide software solutions for the front, middle, and back office of firms like yours in the private equity, venture capital, commercial real estate, and broader private capital markets. So check us out at assetclass.com. We'd love to talk. Now, on with the episode. Yeah, it strikes me, it's certainly interesting in the VC community on the West Coast. When I was raising capital for a prior venture, there actually seemed to be a reasonably high number of people who'd come from a military background into venture capital for whatever reason it was attractive. Um, why do you think that is? Is there something that they share in common, or that the mindset of a discipline of military moving into that space, that it has something that is attractive to that type of person? Or
Well, I think that the military background forces several, uh, uh, allows an individual to develop several core strengths that may not be uh, present in your non-military college graduate.
Mhm.
Like, we're forced very early to be leaders.
Yeah,
Very early to understand, yeah, and how to communicate a plan and execute. You understand um, how to be, a leader and a follower at the same time, because you've got, older, more seasoned folks who are telling you what to do, and then you've got to get the team rolling. But then, beyond that, I think there's a lot of, merit-based decisioning that military folks are instilled with, and that's very much the case when you go and look across your portfolio, or you look across prospective portfolio investments. You've got to kind of have that mindset to be flexible, but understand that the trajectory has to be up and to the right. But up and to the right can mean different things depending on what the growth metrics are, what the industry is that that company is in, what you're ultimately trying to build.
yeah, yeah, yeah. It's interesting. And so, in 2005, your first fundraising, is it friends and family round? I mean, what does that look like for TTV?
Yeah,
You're obviously at Fund 6 now, $250 million fund, 750 deployed. But in the early days, what did that look like for you guys?
so the first fund that Tom and Gardner raised was a $37 million fund, and
Okay,
bulk of that came from Synovus Financial Corp, which is a big bank here
right.
in the southeast of the United States, and that was a very successful fund. They
Yeah,
were very first investors in a company called Greenlight, which really kind of established this stored value or marketplace. And when we went out to raise our second fund, in a lot of ways, everybody just kind of doubled down. And
yeah,
our LPs came back, and well, we went from the 37 million to an 80 million and started.
right.
Wow.
So if we think about the timing, you're raising in 2005, starting to deploy, as we start to approach the 08, 09, you're kind of getting into pretty sketchy territory potentially. How did you guys navigate that? Was it extremely challenging? Did it teach you valuable lessons, or was it actually positive for where you were exposed? What was the or combination of all of those?
So it was extremely choppy waters.
Hmm.
Needless to say, you're going into the financial crisis of 2008, 2009, and
Hmm.
you have a portfolio of early stage financial tech companies. So our customers, a lot of
Yep.
our vendors were big banks. And so we have very, very choppy waters to navigate. We learned a ton of lessons in that second fund.
Hmm.
We were in scenarios where we would have a portfolio company that might offer a credit card solution. Um, and our warehouse lines were being pulled by the biggest banks because they were shutting down all kind of third party relationships to weather
Yep.
their own storm. Uh,
Right.
we learned coming out of that, when you're growing an early stage company, you've got to make sure there's not a single point of failure in your value chain to deliver what you're trying to do. So you can't have one bank providing you with a warehouse line. You need to have at least two, right? So
Right.
we also learned a lot about CapTech application. We made some mistakes in terms of trying to save every uh, company in the portfolio and didn't lean into our winners as much as we should have, frankly. And that's something that we've taken to heart, and we've used those lessons coming out of Fund 2 to develop solid, strong returns for Funds 3 through 6.
Right. Am I to read from that that the lesson learned was not to spread yourself so thinly that you couldn't continue to back those winners, or what was the, or when you say not leaning in heavily enough into those that were
Well,
progressing, what
you
does that
can
mean?
look across your portfolio and see some companies that seem to be doing, and you would say, I can take the reserves from this company that seems to be doing fine and
Yeah.
allocate them to try to help someone who's not doing it.
Right. Okay.
Really, what you need to do is you need to recognize not everybody's going to make it out.
Yeah.
And you let those folks go and you lead into the ones that are going to.
Yeah. Okay. Okay. Yeah, that makes sense. Um, okay. So, kind of fast forwarding a little bit, then when you get through that, so that was Fund Two being deployed around that time. Um, I guess what we certainly seen talking to other firms who are operational around that time was that if you could raise the capital, it actually turned out to be a pretty good vintage for various reasons, depending on the markets, of course, that you're investing in. Um, but how did that kind of play out for you as you then leaned into funds 3 and 4? So how did the business grow or progress? Was
Well,
there
yeah. Well, coming out of the financial crisis, there was a lot of restructuring from a regulatory perspective
right?
inside Washington, D.C. And one of the big things that put us really, really hard was something called the Volcker Rule. And the Volcker Rule was in the Dodd-Frank Act, and that effectively declared private equity as too risky for banks to maintain any sort of exposure to at the time. So
Right.
we lost a gigantic chunk of our installed LTE base, which was some of the financial report, because some of us could no longer be a limited partner moving into Fund 3. So we really had to go out and reset our entire LP base in Fund 3. Now, fortunately for us, one of our key relationships with thesis flow systems who
Yep.
at the time of the initial investment by Synovus, thesis was a publicly traded fund, but 80% of their shares were maintained and owned by through understanding trust for one of the sub things Synovus.
Right.
Fortunately for us, TSIS and Columbus Bank and Trust were kind of divested their interests. So TSIS was no longer really part of what Synovus owned them. And they came in as our anchor to fill Synovus' shoe in Fund 3 and have been one of the department ever since, including their merger with Global Payments, and they continue today to be fixed forward.
Yep.
Fund 3 was a smaller fund. We were very judicious about deploying it. It's been a successful fund for us and really springboard our we would really provided a springboard for us to raise 426 very successful.
Yeah. Yeah. And when you look back at some of those breakout companies, you mentioned Green Dot. What other companies kind of come to mind in a positive sense in terms of being instrumental for, it is a parallel, sector, and you need these breakout successes. What are those companies in your portfolio that
So
really broke through for you?
really defined by both Bill.com and Paralytics. Great
Right.
public company was born out. Uh,
Mhm.
Three, we did quite well with tablet-based point-of-sale company called Shopkeep.
Okay.
We also found in the unicorn in there, which was Salt Lake City Index, which we're very proud of. And we have a little backer of the land and whiskey.
Yeah. Yep.
When you move on to fund four, which may be Splunk perhaps, that's got the Splunk asset in a complete full uh, Greenlight in there,
Oh,
which is
Greenlight. Yep.
a very, very big company now.
Yep.
And we did real well with Featurespace, which Visa paid $1 billion to buy back in last December. So you move into five. Five's that early winter. That was some crazy times coming out of COVID. You had a company like Caxbit, which did extremely well right out of the gate, and we're able to return a lot of capital back to our LPs with that. It's got several other good ones, Wildfire, Sandpart in there. One
Mhm.
Valley Six. Too early that that'll be going to be the first unicorn, but we have a couple, mainly they have the roadways, which are racing towards that moniker, and we just added a couple new ones that are growing extremely fast in the Clarity. So we're very, very excited about what the portfolio has in it right now,
Yep.
and the opportunity will be for monetization. And I really feel like I'm not doing justice to the rest of the portfolio because we've got a lot of really good companies, especially a group. One of my favorite founders is a gentleman named Rod Batham, and he founded a company called Ferguson. And he's since changed the name of that to Fight, but they were really the very first embedded accounting solution out there and have done extremely well. He raised a total of the $2 million he took from us, massively profitable, big business that he built too. Yeah,
Mm.
we love all of our portfolio companies like sure.
Yeah.
I feel remiss, but right now, frankly, I think we have 75 active portfolios.
Yeah, yeah, yeah. No, it's I mean, that's the nature of the beast, isn't it? You definitely need those outliers to, obviously return the fund and just the way the maths work with VC. Just to for people who aren't that familiar with TTV in terms of the stage that you invest in, the profile of companies that you invest in, how would you characterize that from you know, early stage growth? I mean, where do you focus the
Very
majority of your
much early stage. So
Mhm.
seed and Series A is really
Yep.
our sweet spot. We've done a little bit of dabbling in the pre-seed world. I will tell you, kind of in 2021 and 2022, when the markets got really, really heated, we
Mhm.
found that it was better to put a placeholder in a small company so that you'd have some optionality around um, and preempting a Series C or Series A, which
Uh-huh.
we've done successfully in 1/6 of in several companies, including Payable, thankfully. Um, so we will write some very small checks, call it 500,000 or a million, but
Yep.
really we're wanting to deploy between 3 and 7 million right now, with the first check into a new portfolio.
Yeah. Yeah. And so beyond, obviously you've deployed Fund 6. Are you fundraising for the foreseeable, or are you just concentrating more on uh, managing through the
We're going to
deployment?
continue to deploy Fund Six and finish building out that
Yep. Okay.
portfolio. And we're extremely uh, we don't announce fundraisers necessarily just because there's so general solicitation rules around
Mhm.
there. So we will let the markets know when we do formally close the first hold the first close of Fund Seven. Let's put it.
Yeah. Yeah. Understood. Yeah, that's great. And so when we think about, you mentioned obviously quite all within fintech, but you're covering a fairly broad range of, let's say, sub sectors within that. What are the areas of fintech right now that are exciting for you? That are either they can be established and growing, or they're new and hot. I mean, what's when you look at the areas that you invest in right now, what's most exciting to you?
Well, broadly speaking, Brady, we really like to find companies. that can almost create their own category. And
Right.
so I think back to Raj at height, you know, embedded accounting is now a thing. And when he started, it really wasn't a thing. When I think about what him and Jonathan have built over at Greenlight, it's really around building a solution for the household and the household as an enterprise. And this is the financial world for that.
Hmm.
We really want to find category defining companies. Now, when you think about that in fintech, there's going to be opportunities for someone like the Clarity Bank. We've seen companies like Affirm go out and build a buy now, pay later solution, and that's been a branded solution. Clarity
Hmm.
Bank said, I really would like to empower the merchants around the ability to have their own buy now, pay later solution that they own. So
Right.
Clarity is looking and doing that for merchants so that they're not losing that connectivity with their customer because they're turning it over to a branded BNP.
Right.
Um, Safety or security around transaction processing. It's always that's the gift that keeps on giving. The bad guys get smarter, and we need
Yeah.
that. With Featurespace was a great example with that. We love to see opportunities around embedded payments into vertical SaaS solutions. So you're finding companies like Affirm Waste where he's redefining how commercial waste hauling is going, and one of the biggest product needs those folks have is to find a financial tech solution that understands their industry. So those are great opportunities for us to continue to look at and to find. We also are looking, like everybody is, and not to be cliche, but
Yep.
the uses around and the use cases around AI.
Yep.
It has different implications in the fintech space, especially around banking data. Right now, we're seeing a whole lot of movement in the banking data world. Cities, I think they struck a deal with Plaid today, but City was going to start charging all of the groups like MX and Plaid access to any of their data. So you can understand that
Yep.
because it's their data, but
Yep.
you also run the risk of cutting your end customer off from functionalities that they might get from other things. So it's a very
Yep.
interesting um, dichotomy that we see in the marketplace around data and those sorts of things. So all of those things, but we like to listen to the market. We don't want to go out with our own theory of what needs to be built. Instead, we'd like to see what is being built and then test that against norms that we've come to learn over 25 years to find out who's got what that can really build again a category defining business.
Yeah. Yeah. And Sean, when you think about, or let's say collectively, as an investment team, you think about what's happened. That convergence of AI, SaaS, vertical SaaS, and I guess at one end of the spectrum, the claims that SaaS is dead because companies can go out and vibe code their own application, and before you know it, the SaaS business model is no longer viable. What are your thoughts when you look at your own portfolio of SaaS companies? You obviously have exposure in SaaS and vertical SaaS, but you've also got these emerging AI players. How do you reconcile, and what are your thoughts on those types of claims, like real, not real?
Uh, I don't think they're at full fruition yet.
Hmm.
Uh, we have seen in talking to various technologists, both inside and outside of the portfolio, um, the ability to get 80% of the way there with large language models is real,
Yep.
but it's only 80% of the way. And so we are finding that the need to get that last 20% remains uh, a reason that vertical SaaS is not going to go away immediately. You've got to have an understanding that goes beyond what the LLMs can necessarily do, what the AI models can do. I will also tell you that having spoken to CIOs in the portfolio, they some of the more savvy ones were intentionally um, not late per se, the patient around the deployment of AI solutions inside their own tech infrastructure or their tech team because there was a lot of noise to it. And so some of the savvy ones have spent the time allowing for the AI solutions to actually get better around the key functionalities that they're supposed to help service. And
Yeah.
the ones that were broader, maybe the folks who ran out there fast and started adapting and building AI into their solution sets right out of the gate are finding that unwinding that is as a competitive disadvantage now has better solutions to fund the market that are making more savvy folks that much more efficient, 10 to 20 times more efficient or a coder now with some of the tools versus what they were doing just deploying AI generally inside their tech team.
Yeah. 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 I guess the system of record is still required, and when it comes to finance, I'm paraphrasing uh, a point that I heard recently around just the need for accuracy, 100% accuracy, right? When it comes to finance, is what you're looking for, and if you're 0.5% out, you're 100% out, right? So,
And this is a metaphor we use um, 10, 12 years ago.
uh
If you're at the gym and Netflix stops working for you, that's irritating.
yep,
If you're at the gym and you log into your online banking app and you can't get access to your funds, that's a problem.
yep,
It, I think that we've had a lot of technologists run into the fintech space and believe that tech solves all things when there sometimes with an underappreciation for how long and how thought out and how well developed the actual payment rails are and the banking systems are in the United States. If you think about some of the largest buyers of technology outside of my old employer, the US Navy,
yep,
the banking sector and the payment sector was right up there in terms of tech spend starting back in the 60s and 70s.
yeah, yeah, yeah. Well, there's certainly a lot of change going on at the moment. And one of the other points that you referenced in your earlier comments refer to regulatory oversight, regulatory change, um, and you operate in the fintech space. So by definition, you're going to be subject to these regulatory bodies, to that oversight. Um, just interested, perhaps at a macro level, is that kind of governance and oversight? Is it a plus or a minus to you when you're trying to grow fintech companies? Across your portfolio, like, is it overall a plus or overall a minus? I mean, clearly, there are tools required to help manage it, but there's also potential growth challenges as you move cross regulatory frameworks and even internationally, the regulatory challenges that a company might face trying to grow its footprint from one geography to the next.
It really depends.
Hmm.
A terrible punt for an answer, but there are regulatory schemes that need to be in place. There is no doubt. And those schemes that are in place offer the entrepreneurs who take the time to build those regulatory schemes into their product and solution set, that built a moat. And if you spend the time to do it right, you'll find that if you're out ahead of the curve, the fast followers behind you are often going to run into an issue because they're not thinking about all of the regulatory stuff that needs to be done. Now,
Right.
at the same time, kind of the overreaching regulatory stuff that may swing the pendulum too far can inhibit growth. But here in the U.S., we're really seeing an interesting dichotomy. With the change of the administration, we saw the Consumer Financial Protection Bureau effectively go away.
Yep.
But what that ended up doing was now you have the data issues that the banks are starting to say you can't touch my data without paying for it, which is then hurting the consumers, which may end up bringing this DFPB right back into existence. So there's a fine balance that needs to be struck. But Europe is a very challenging one with the PII issues and the data
Yeah.
issues. That's it's very difficult to deploy certain solutions that are there, just given the amount of restrictions around the spaces around the. All that
Yeah.
said, 25 years in, if you understand those things, as you look across potential opportunities to invest, we can bring a little bit more value add. I will tell you the number of times we've running a company that don't understand um, what it means to have to get a money transmitter license and the various um, believes that they can get around money transmitter licenses with certain bank charters or something along those lines when in a lot of ways attorneys generals across the United States look at an MPL as a way to extract some revenue for their state coffers for a group that's not going to be screaming and yelling and getting a lot of public sympathy for what they do.
Yeah. 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 So yeah. Well, as you say, I guess just to come full circle on that, it does depend. There's a lot of a lot of variety there, but yeah, I wonder, Sean. You're now 20 years from your 2005 entry into TTV. So 20 years on, as you look at the experiences over that time, and obviously been through a number of cycles, right, positive and negative, over that time, are there sectors that, um, with all of that, the benefit of that hindsight, that are really exciting for you right now, and then equally, are there sectors that you would not touch with a barge pole because of, you know, lessons learned? Um, any insights you can give on either side of that coin?
Um, Maybe some of the stuff I personally would avoid. Um, Foreign currency exchange businesses, I think, are going to be stressed fairly substantially as there's a further um, normalization of the use of stable coins,
Yeah.
right? So
See Stripe,
that's one to,
yep,
yeah, potentially, think about not going back and messing around there. And frankly, we've done quite well with crypto investments.
yep,
And are very bullish on the opportunities to utilize distributed ledger to create better, faster, more efficient products.
yep,
All that being said, we most of our crypto folks to recognize your business is going to grow faster if you're not leading that it's a crypto company versus that it's a company that does looking better faster for the consumer. More consumers that still don't really understand crypto for that investors are complete that. But a
yep,
lot again, I continue to be consumer FinTech is kind of waned a little bit in its popularity. All that being said, back to your regulatory question, with the regulatory environment in the United States where it is now, we're starting to see the IPO markets open back up in a fairly substantial way, and
yep,
that's going to float clear. I think that a lot of great companies that have been waiting to go public get out there, and so you'll have your next opportunity, and a lot of are building the next great fintech or something along the
y
following along, following along with stuff, with following along many of these IPOs with Steve. So,
yeah,
um, moving forward again, I think the use cases around figuring out how to harness and build AI into financial services in a manner that is both beneficial to the consumers, but also um, down as it comes to the management of money and the regulatory schemes around money. I think those are brand.
yeah. And you mentioned, stablecoin and, I guess, broadening the, um, I guess, the definition of areas of finance that will be impacted, or at least fintech that will be impacted by, Web3 blockchain enablement. Is that a trend that you guys are? Do you think its time has come now? There are obviously some major moves and some major players that are kind of stepping into that and adding more credence to to that market. Is that an emerging sector that's exciting for you guys?
We definitely pay attention to it, no doubt about it. We already have several investments in that space that are benefiting from that ingredients and normalization, if you will. Let's take sure.
Yeah, yeah, yeah. Very good. Um, Okay, and I guess, Sean, just kind of in closing here, we understand the background to TTV, your focus, the markets that you play in, the stages that you invest in, the successes that you've had, maybe some of the areas that you're you're keen to avoid moving forward. Right along that period of time, I know you were recognized recently. Congratulations on being recognized by the Georgia FinTech Hall of Fame as a recent inductee. Tremendous, obviously recognition of you and your contribution in the state over that period of time. Um, Given your experience and almost entirely with TTV and your contribution to the state, what advice would you give to perhaps early stage companies that are looking at ideas in the fintech space before they come and talk to a firm like yourselves? Like, what are you looking for in terms of profile of either teams or state of readiness or pre-revenue, early revenue, proof of concept, product market fit? What does that look like for you, given your experience and your focus?
So with those, I think if you look at Broadside portfolio and that with their profile of the companies that have one been successful in fundraising and two been successful moving beyond fundraising into hypergrowth.
Yeah.
Those characteristics that they pull to share are yes, they are revenue generating at the point of time when we're investing. Maybe the most important thing that we find in the management team is experience where they have realized through personal or professional challenges a uh, a, a problem,
Hmm.
and it develops a solution set to fix that, and they can articulate why so others need to utilize their solution to fix their own problem in a way that they can get others to build business cases for spend their money to do it. And it sounds very basic, but well, I found certain technologists, come to you and they love the tech that they get. And the tech may be incredibly cool, but it doesn't really solve problems. And if there's not a problem that it's addressing, then it's going to be really hard to build a business. You can create a great tech, but you have to have one sort of business case. And the ability to articulate that business case really separates the top performing entrepreneurs from the others. Beyond that, um, being coachable is unbelievably important.
Hmm.
When I was first getting started in the business, we would want almost at leading questions for me where I know the answer I want to hear, and so I'm going to ask a question of the entrepreneur who's pitching me the question in a manner that they're going to give me the right answer. That doesn't help them, that doesn't help me.
Right.
So we've found that sitting back and listening and letting them talk and then providing feedback and finding out how coachable they are in early meetings and how responsive they are in early meetings is a great litmus test for future success. But we also try our best at TTD not to pile or the top bound. It's going to be helpful in taking some of that load off of their plate and finding ways to help them grow and being as founder friendly as possible so that we can have a lot of success stories with folks doing great and making a lot of money and with changing their lives and changing the lives of others.
Yeah. Yeah. Well, on that positive note, and I should say, as from a disclosure perspective, as an investor in asset class, you guys have been great, very supportive. Certainly a great source of advice and insights as we continue to grow our business. So that's very much appreciated. As is your time today, Sean. I know you've got a ton on, and it's really been great to catch up with you, get some insights on the background, some of which I was not aware of, personally as well as professionally. But for today, Sean, on the People of Private Capital, thanks very much for your time. It's very much appreciated.
Great, thanks for having me.
All right, thanks a lot.